Okay, so this is the Australian dollar currency pair, and we're just going to look at some fundamental trades. So the first step is to get an overview of what's happening in the market. And you can do this by visiting the news sites such as Bloomberg Currencies, ForexLive.com, etc. Or you can use the news feed to get an understanding of what's happening in the market. The next step is to understand what was driving yesterday's market sentiment. Then you get an understanding of what was driving the previous trading session sentiment. And once you understand that, then you have to analyze the current market sentiment and identify what is driving the current market sentiment. And you can do that by using news feeds or going to the news sites. Now, when trading fundamental analysis, we prefer to trade in the direction of the fundamental outlook of the currency. However, there are times when you may get bullish trade on currencies that have a bearish fundamental outlook, but these trades are normally short-term trades based on sentiment change. Okay, now when trading fundamental analysis, we don't just enter the market at any price. We look for what is called a good price, and good price is when the market reaches, for example, a resistance or a support, a pivot point level, a 200-day moving average, or a Fibonacci level. Okay, those are what we call good points, and those are the points that we look to enter the market. For example, okay, if we're looking to sell this, we would not sell the market here. We would wait for a pullback and look to sell somewhere in this region. Why? Because here is a past support, future resistance. So we look to sell somewhere around this region. Okay, so we draw a horizontal line here. If the market is here right now, we would love to see the market come to this level before we look to sell. Also, this is where the 200-day moving average is, and this is the average price of the market. So if the market reaches a 200-day moving average, that's a good price to also sell. Just depends on your risk appetite. The next thing we use is the Fibonacci. We use this tool, the Fibonacci, and we draw it from the lows to the highs like this, and we look to enter at what's called the 5-0 level, the 5-0 level on the 618 level, which is this level and this level. In this region is what we call the kill zone. This is the region where we look to enter the market when trading fundamental analysis. Okay, so we look to enter the market in the kill zone. So if we're going to trade this, we're going to wait till prices reach to this level. Right around this level, here's a 200-day moving average. So prices would be a little bit above the 200-day moving average, and it would be right in the Fibonacci zone. Right, it will be in the Fibonacci zone, and it would be near the past support, future resistance level. So this is a good sell, but we can't just sell this market like this. We have to sell it based on the fundamentals. So what we're going to do is we're going to go to the economic calendar. This is the, say for example, this is the 26th of April, right? So this is 26, and we're going to look for the 26th of April. And we're going to look to sell the market before a fundamental announcement. So you can sell the market after the fundamental announcement. You can trade after the fundamental announcement, or you can trade before. It just depends on the risk and the analysis of the trade. If you know that the fundamental announcement is going to come out bad, then you can enter the market before. If you're not sure, then it's best to wait until the release of the fundamental announcement, then you enter the market. For example, on April 27th, we have consumer prices for the Australian dollar. Now, this is a high volatility economic indicator. It's going to cause high market volatility. So prices are going to move whenever this announcement is released. So April 27th is when we're going to get this. So if you're trading, for example, if you're trading here, which is the 25th, it's best to wait until April 27th to enter this market. Okay, because that's when we're going to have CPI indicator for the Australian dollar. It's going to be April 27th. So you wait until the 27th. So as you can see, the market rallied and it came right into what we call the kill zone. Remember the 5-0 level and the 618 level, right with the past support, future resistance. So this is the kill zone, and it's also near the 200-day moving average. So this is the kill zone, and we're expecting is CPI data to come out worse than expected. And that's because we're following the news feed and we understand that most analysts are expecting the CPI data to come out worse than expected. So we're looking to sell this Australian dollar right around this level. So you can sell it before when the market is anywhere in this region which stops above the high. So you'd have to risk a 100 pip stop, okay? Or you can sell after the event, which means you would enter the market somewhere around here. You would enter the market somewhere around here and your stops would have to be up here. So as you can see, CPI data came out worse than expected. It was expected to come out at 1.8%. The previous was 1.7 and they were expecting 1.8, but it actually came out at 1.3%. So this is worse than expected. So as a result, the market fall. And why did the market fall? Because poor CPI data. Remember, interest rates is the fundamental driver of market prices. So if CPI comes out worse than expected, then that's telling us that the central bank may lower interest rate, because they're going to lower interest rate to try and increase the CPI. They're going to try to increase market demand by lowering interest rate, increasing the money supply, so there's more demand for products, which should cause prices to increase. So that's what we're expecting them to do. So whenever we have a bad deviation in CPI, meaning a worse than expected CPI reading, then we're going to expect these guys to be looking towards cutting interest rates. That's what we're expecting them to do after seeing this. Also, if you go to the news feed, okay, you can see that the market sentiment, it says this data directly plays into the RBA's monetary policy decision, and this miss has greatly increased chances of an RBA cut at the May 3 meeting. Okay, so with the probabilities jumping to nearly 50% after the release. So most fundamental traders now are expecting these guys to cut interest rates.